right, I wanted to do a quick video about credit spreads. Quick update. We went up and down today. Today's crazy, but yeah, I mean, with the Fed looking at whether they're going to cut things or not, it's been crazy. But point is, some good things. Riley has rallied significantly from where it was, and my positions are looking pretty good. I'm actually possibly going to make money on all my puts on Riley, but either way, I'm just going to suck it up. I've had a couple people ask about how do you put spreads and what's your methodology. So that's specifically these on SPY. I like SPY because it's pretty stable. I also use the Qs. They're highly correlated. The Qs are more volatile because there's more tech in there, so it goes up and down more and faster. But SPY, for example, today, it dropped 4 points. So specifically, I want to go over all right, how many days to, it's basically everything you need to know to actually do this relatively safely. Because even if you do pretty good deltas, if you are too short term, you got to realize that increases your risk, because the market can jump up or down 10 points in one day. So what I like to do is go 10 days or more. So I usually look not next week, but the week after. And then next week is when I look to close it, because I like to close it at about 50% of the time. So when you make these, try to go double the time that you want to collect. So I like to collect every week or so, sometimes every other week, because I make so many positions. And then when you increase the time, you decrease your risk, because you can take a more probable position, and because the time frame allows you to do that and still make a good amount of money. So today's the 11th, so let's say this is about 11 days out. Let's go to the Friday on this week, which I guess that's the Monday. So let's go to the Friday. So I'm going more than 11, whatever, 15, 16 days out, 2 weeks out. And I'm going to go, timing in terms of when to make a put is also when the market's a little bit down. So it had a pullback today because it went up so far. Let me show you that again. See this big jump? It jumped up, so it came back down to those previous levels. It went down a little bit lower. But you can see it kind of is reasonable, right? So try not to make puts when you have a big jump up like this. Make a put when there's a drop down like this. So now is a perfect time to do a 2-weeker out here. So go out to 26, let's say. You don't even have to go this far. But I like to look at those 80 percentiles, so around 20. And you can tell because the $1 put. See, so that's a sub 20, but it's about that 14, 15 delta. So I like to be sub 20 just because it's safer. But so the 20 would be fine here. I like to go a little bit safer, so I might go to the 17. And then how wide do I like to go? 2 or 3 strikes, so that's risking $200 to $300, and I'm getting that 10%. I kind of don't like that because of how I've analyzed the market. I'm pretty sure that it's going to come back up. I can take a little more risk, so here I am doing that 20 delta that everyone talks about. And that looks a lot better, right? So it's more than 10%. And that's why I always say, if you're going to go outside of SPY or the Qs or the big index funds, you better be getting better than 10%, because otherwise, why wouldn't you just do SPY? It's just better. There's more liquidity. You can get in and out easily. The market's already going back up. It's 57. It was 56. And then how I close these positions, I like to take kind of I think 38 is pretty good, where you're pretty close to the bid price and then sit on it for a minute. And it'll probably go through. And if it doesn't go through after a minute or two, then I'll bring the price down. So anyway, maybe I won't even do it because my buying power is a little bit sketchy. Oh no, it went through. All right, y'all. So there it is. That's how you do it. And tomorrow, I'm probably going to close some positions, so I should be fine. All right, y'all. Hope that makes sense. That's how you do a put credit spread.